informational video in regards to infinite banking. What I would like to do now is to be able to tell you a little bit more information as to why infinite banking is a choice for you. What I always try to get people to understand first and foremost is that infinite banking is not an investment. This is not going to replace other places that you put your money. This is where you put your money before you put your money somewhere else. Because the banking part of it is that you have the ability to put your money inside of a life insurance policy and then borrow against that money and then use that money for for something else. Your money remains inside the policy and it will grow with uninterrupted compound interest. And that's something that will benefit you for a long time. And that's what we're trying to, that's what we want to be able to teach you is that this is not an investment. You cannot lose your money. In fact, you receive more benefits by putting your money here first. So what I'm going to do is I'm going to kind of go through and explain this. Um, uh, and so follow me on this PowerPoint presentation. And if there's any questions that you have the opportunity to, just go ahead and write them down. And then when you and I have a conversation, feel free to bring up those questions, okay? So let me go ahead and get into this PowerPoint presentation. And let's see here. Let's go here from the beginning. Let's go here. All right. So now, first thing I want you to know is that I'm trying to simplify the process. When it comes to infinite banking, what you need to know is realize this, is that infinite banking is all about controlling your money. Everybody has been fighting for control of your money since the beginning. It started with your piggy bank, okay? When you have a piggy bank or when you try to get somebody to put their money into a piggy bank or a jar or whatever it is, you're being taught. So you've been taught how to think about your money. And you've been taught a certain way so that somebody else could benefit from your money. Now, it was John D. Rockefeller that said that he didn't want a nation of workers. Excuse me, he didn't want a nation of thinkers. He wanted a nation of workers. When we go to school, when we go to elementary, when we go to middle school, when we go to high school, we've been taught how to think, not for our benefit. We've been taught how to think how they want, or whoever it is that want to have control over our mind and money, how they want us to think. When it comes to our finances in the financial institution, it starts with the piggy bank. The piggy bank, we're taught to put our money there, let our money sit there, and for us not to touch that money, okay? Then we're taught, and now keep in mind that we're not getting any return on our money in that piggy bank. It's just stacking up, we're just saving it. But if you think about it, as time goes on, our money loses value. So this money that's sitting in the piggy bank is losing value. So then you go from putting your money in the piggy bank to putting your money into a savings account, into a bank, into a savings account. Yeah, you're supposed to get some interest rate, some return on that money, but you're also paying taxes on that money as well. And now you're told to put that money there and just let that money sit there, right? Just let it sit there. And then you're told to go out, get a job with a 401k, put your money into a 401k, let that money sit in that 401k for years and years and years without touching it. That money's in like a tax prison. You're not supposed to touch the money till you're 59 and a half, otherwise you get taxes and a penalty. Then once you take the money out, it used to be 70 and a half, now it's 72. Now at 72, you can access the money. If you don't access the money, then they're going to penalize you. They're going to penalize you up to 50% or 50% of what you should have taken out. So your money basically becomes into a prison when you put your money in a 401k. They don't want you using that money except for certain circumstances. You can borrow the money. Now, keep in mind, your money's sitting there. Now, why don't they want you to touch it? Because they're touching it. Your money's not sitting in the bank and nobody's using it. They just don't want you using your money. Your money's not sitting in a 401k and nobody's using it. They just don't want you using it. So keep that in mind. Somebody is using your money and they're making money off your money. In fact, if you were to go to BauerFinancial.com, you will find out that banks get anywhere between 300 to 1,400% return on money that's deposited into their accounts. That's a lot, 300 to 1,400%. So they're flipping dollars, and banks are smart. They're making a lot of money off of other people's money because why? You're controlled how to think. They have they do house loans, car loans, uh, you know, credit cards, all this. They own these buildings, and it's none of their money. They're using other people's money. Okay. Now, my goal is to show you how today how you can do the same thing that the bank is doing with your own money. Uh, that's objective today. Okay, is to show you how to do that. Okay. So now let's look at infinite banking and simplify. Years ago, there used to be a commercial that said that when E.F. Hutton talked, people listen. And so what people don't realize is that E.F. Hutton was a stockbroker. And what E.F. Hutton was talking about was life insurance. Totally different what they normally do. But what E.F. Hutton figured out is that a person can get a fixed rate return on money without having any losses. And at that time, there was no cap as to how much money you can actually put inside of a life insurance policy. So a person would have a $50,000 death benefit with $100,000 cash that they could access from that policy. So what happened is that E.F. Hutton had done so well with their marketing and campaign that there was a run on these stockbrokers companies, and people were taking their money out of these stockbrokers brokerage accounts and putting it inside life insurance policies. So what happened is that the IRS took E.F. Hutton to court, and they lost because what E.F. Hutton was doing was legal according to the IRS rules. You know, a person could have more money inside of a policy than the death benefit, and when a person pulled that money out, the money was tax free. So what happens when the IRS loses? Of course, they're going to change the rules. So they change the rules. That's how we got TAMRA, TEFRA, and DEFRA, some rules that basically limits how much money you can put inside of a policy so soon over a period of time. So you just can't put, a huge, large lump sum of money in a life insurance policy and it not becoming what's called a modified endowment contract, which is basically a qualified plan like an IRA or 401k. So the main benefit that we always want to have with life insurance policies for you to be able to put money in and pull money, put money in and be able to take money out tax free. And there's still ways in which you can put a lot of money inside these policies and do that, but it has to be structured properly. So the IRS changed the rules, and so now you can't have a $50,000 death benefit and have more money inside the policy. The death benefit, the cash inside the policy has to always be lower than the death benefit. Okay, so we start off with the death benefit for your policy, which is going to be higher than any cash value that's inside your policy. Our main objective is to structure this policy in such a way that you're going to get a lot money going into we want more of your money that you're paying in your premium going to your cash value than actually going to your death benefit. So we have to structure it in a way that actually makes sense. And here's the thing. When you normally talk to a normal life insurance agent, that life insurance agent is going to realistically just give you a base policy where the premium that you're paying is going to your death benefit. That's not what we're doing with this. The other thing is that when a life insurance agent structures a policy like that, you get higher commissions. When we structure policies like this, our commissions are much lower because we're structuring this for you to win, for you to have more access to the money. So you got your bank, and the way you access this money, there's three ways you can access this money. There's a good way, there's a bad way, and there's a sad way. Good way is through policy loans, and where you actually borrowing against your cash value. Okay, you're borrowing against your cash value. The bad way is you close out your policy and you withdraw your money. That because the reason why I call it a bad way is because now there's that's a taxable event. So you're going to have to pay tax on that money. And then the sad way, of course, is that when a person passes away, that's how the family accesses the money. So everything starts with a properly structured whole life insurance policy. Okay, which basically means that our main objective is we're trying to get you as little life insurance as possible. The death benefit, we want that as low as possible. And we do that by using a small base policy because, that's where everything starts, the base policy. But we want that's the most expensive part of it. And we want that to be, the payments on that to be as small as possible. But we need to get that death benefit big. So we come in there with some cheap term policy because remember, we get into that death benefit. We don't never want the cash to exceed the death benefit. Okay, so we come in with some cheap, inexpensive term policy in order to give us more life insurance or death benefit or some room to put cash in, and then we would use what's called a paid up addition rider. This is really where the magic happens because that policy is paid up, but you can actually use more money or put more money into it to pay to buy additional insurance. So that allows your money to grow even more. Okay. So what happens? You pay your premium. Our objective is to have, once you pay your premium, we want most of that money as much as possible going to your bank. To your bank, we want you having as much access to your cash value. In fact, there's a time down the road that we want. If you're paying in $1,000 per month, if you're paying in $20,000, $30,000 per year, we want you to be able to pull out every single dollar that you just put in. That's how efficient we want this policy to run for you. And then, there's a portion of your money that goes to your death benefit. Once again, we want that to be as little as possible. Okay. Now, as far as these loans are concerned, they're interest only. They are usually less than 4%. No qualifying, no terms. If you have money inside of a bank, you want to borrow money, you would have to qualify for that money. Okay, and if you qualify, they're going to give you repayment terms. When you have money inside of a life insurance policy, you want to have a policy loan. All you have to do is just put a request in, and the money goes into your account. They're not going to give you any. They're not going to give you any repayment terms, so you don't have to worry about that. But you do want to pay it back. Okay. If you have, let's say, for instance, if you have $100,000 in there and you borrow 50,000, they're going to put a lien against that 50,000. What basically means that you can't touch it again until you repay it. You still have another 50,000 that you could use if you need to borrow more money, but it makes good business sense for you to pay yourself back. Okay, so you can keep on using that money over and over again. That's what the banking concept is about. But if something happens and you borrowed that 50,000, you weren't able to pay it back, nobody's going to come after you. You don't have to worry about anything. What happens is that $100,000 that you have in there actually got you a death benefit, probably a sizable death benefit. So if something were to happen to you, what would happen is that your family will get the death benefit minus that $50,000. Okay. Now I want to also get a misconception cleared up here. As your cash value grows, so does your death benefit. So in essence, if something were to happen to you, your family will get the cash value and the death benefit. That's how we do it. We do it an increasing death benefit. Okay. Now policy loans, once again, you can use the money for whatever you want to use it for. And that's what the bank does. See, there's two types of life insurance companies. There's stock owned and there's mutually owned companies. So you always want for banking to use a dividend paying whole life insurance company, whereas not only is where you get the guaranteed growth, but you're also going to get dividends. Once again, there's two types of companies: a stock owned company and a mutually owned company. stock company, the stock owners will get the dividends, and that's from the profits of the company. On a mutually owned company, the policyholders are the owners of the company, so they get the dividends. So you get a guaranteed growth, not based upon the stock market, not based upon anything that's happening in the economy. It's based upon that guaranteed rate. Was 4%, now it's around 3.75%. Get that 3.75% compound interest plus dividends. Okay. And typically, the growth on the money is going to be higher than how much you're going to be paying on the policy loan. And this is simple interest. The difference between simple interest and compound interest: simple interest, you just get the interest on the principal. Compound interest, you get the interest on the interest and the principal. Okay, so it just keeps compounding. So the reason why banks do this is because banking is all about the money flow. They want the money flowing. They want, money sitting still doesn't make money. Money has to be moving in order to make money. You got to keep the money in motion, and banks understand that. They get you go to the bank, you put your money into to the bank. That money, typically what they do is banks put the majority of the money in tier one assets, which is whole life insurance policy, where you can put your money. Instead of you getting 0.01% on your savings account that they're giving you, you can get that 3.75 to 5, 6, 7%. That's what you could get, because that's what they're doing. They're taking your money from you and they're putting it there and giving you 0.01%. That's crazy when you really think about it. So, but they put it there first in order to keep money in motion. So they put the money there, then they borrow against that money. They give the home loans, car loans, the credit cards, all that stuff. Now think about this. Banks have the largest buildings and all that stuff and all these home loans, and it's none of their money. This is money that coming off from the depositors. And what this is called BOLI. So be like the bank. Do bank owned life. They have bank owned life insurance. So do your own life insurance because now you are putting yourself back in control. Why are they doing it? Because it's zero risk. This is, as I said at the beginning, this is not an investment. You get guaranteed growth. That 3.75% to 7%, wherever it's going to be, you're going to be getting interest guaranteed where that money is sitting, whether you borrow that money or not. You should, if you put money in this, you need to be using it for what reason? Infinite. You figure out what you need it for, whether it's flipping properties, becoming a lender, buying cars, whatever. You put your money here first. Whatever purpose you have for that cash that you have, put it here first. Then you go ahead and send it somewhere else. Okay? Family protection. Because it's a life insurance, there's a death benefit associated with it. So not only do your family get that cash, but they also get something, it grows into a higher death benefit versus the money that's in the policy. It's protected from creditors. Okay. So your creditors, they can't touch this money. This money can't be touched by lawsuits. Whether you I don't care how you feel about the O.J. Simpson situation. One thing that we know for sure is that O.J. Simpson, his money that was inside of a life insurance policy could not be touched. Could not be touched. Okay. You have tax-free access to the money. So as long as we properly design it, as long as you follow the MEC modified endowment contract limits that were set when you first start your policy, and I will tell you, what your MEC limits are based upon all the particulars. As long as you don't exceed that, you're able to access that money tax-free. And also you get uninterrupted compound interest. Now, you got to understand the power of compound interest, and therefore you really got to understand the power of compound interest. If I was sitting across from you right now and I had a suitcase full of crisp $100 bills, stacks of it, and it was $1 million. And I said, okay, look, you can have this $1 million, or you can have this penny that I will double every day for 30 days. Which one would you take? Be honest. Which one would you take? Okay. Here's the reason why I asked that question. So if you chose $1 million, you lost $4.3 million that you could have had if you just waited. That's the power of compound interest. As you can see, as we look at this chart, it takes a while for things to compound, but once it gets the rolling, it starts rolling. Okay. Once it starts rolling, baby, it starts rolling. So now you have $5.3 million at 30 days. Now, let me show you the power of interrupting that compound interest. Let's just say, for instance, at day 15, I say, yeah, I'm gonna take out $100. Then at day 25, I'm gonna take out $100. The question is, how would that affect me? Or would it affect me at all? It shouldn't, right? Okay, let's take a look. I lost $3.2 million just because I took out $200. That's crazy. That's crazy. But listen, you're doing that. You are already doing that by putting your money in the savings account, saving up to a certain thing, and then pulling money out and buying it. You've interrupted that compounding interest that you could have a lot more money. That's a problem. That's an issue. Whether it's your business, there's people that have $100,000 in there to pay the taxes for their business. They pull it out and they pay the taxes. They're not getting interest on that money anymore. No, you got to stop it. Continue to get uninterrupted compound interest on your money. It will grow. Okay. Now, I want to thank you for listening. I'm sure that there's additional questions that you might have. You're going to have all my contact information. I'll be more than happy to sit down and go through that with you. If you want to see your numbers, I want to help you to look to see what your numbers are as far as if you're trying to put away $500 per month, $1,000, $2,000, $20,000, $40,000 per year, whatever it is. There's some agents out there that are doing the same thing I am. If you're not putting more than, $2,000, $1,000 per month, they're not going to help you. I'm not that guy. I will help you. Okay. So what I would want to do is keep in mind that this is life insurance. So the person does have to have reasonably good health in order to qualify for this. So I like to meet with you. I like to go through and to talk to you about how, to do an illustration for you based upon how much money you want to contribute. Then once we go through the illustration, you see that it's efficient and that it's going to work for you, then we go through the application process. Then based upon your age, you may have to have an exam. Or if you're within a certain age range, you may not have to have an exam. Then it goes into underwriting, then it's approved, and you're off to the races as far as your banking is concerned. And then we're always going to be here to assist you with your banking purposes and your banking needs. Once again, my name is Carlos Millsap, and I want to thank you for listening to me today. Take care. God bless you.